Now let's say someone inherited something that's not an IRA, that's after-tax dollars, whether it's a home or whether it's a brokerage account or even cash. What happens there for a beneficiary?
So they get a step up in cost basis. So if you inherit a property, let's just say for $800,000, you are now not taxed on $800,000 that you inherited. So if you keep the asset and it grows, you will be taxed on whatever it has grown. But I think it's important to work with a financial advisor to now, okay, I have this money. Let's just say I've already been taxed on it. What do I do with it now? What's the most tax efficient way to invest this money?
But to go back though, just about that term, because I think we use that term a lot. We bandy about step up in basis, your cost basis. What exactly is your basis, and what exactly does that mean, step up in basis? Because you explained about the 800,000, but because is it properties, is it stocks? Where does this basis play a role?
Yeah. So let's just say your Aunt Becky invested $200,000 and bought this property. So her cost basis is $200,000. But let's just say in 25 years, it's now grown to $1 million. And Aunt Becky unfortunately passes away, and you are now the beneficiary of that property. She bought it for $200,000, but you're inheriting it when it's a value of $1 million. So now you won't be taxed on anything above $1 million.
But to be clear, we're talking capital gains taxes, or what do you mean by not taxed? Because I do know that estate or death taxes play a role here. And I'm not sure if you want to pick that one up.
Yeah. So any non-qualified asset, when we talk about non-qualified assets, that's money, assets that aren't in IRA. So properties, right? Stocks that you own. Maybe you bought Tesla stock 10 years ago and you held it in a brokerage account. All those assets receive a step up on cost basis, meaning the cost becomes whatever the fair market value is of that asset at the time of transfer, which is the time of death, okay? So now these beneficiaries inherit these assets and they're not subject to taxation as far as capital gains or income tax is concerned. However, Massachusetts has what we call estate tax, okay? And estate tax says, well, how much was Aunt Becky worth, all of her assets at the time of her death? Her home, her Tesla, her stock, her life insurance, you add all that up and there comes a value to that. And dependent on the total of that value will determine if that estate has to file as estate tax return estate taxes. And this gets really complicated, but roughly about $2 million each individual is allowed to have in assets that they are in control of without having to pay Massachusetts estate tax. There's a federal level, which is a lot higher, around, I think it's like $27 million. But the state level is $2 million per person. And that's been a significant increase since over the last 2 years. It used to be $1 million per person. And a lot of people from Massachusetts were calling themselves Florida residents, right? And Massachusetts says, we got to solve for this problem, and said, we'll raise the exemption to $2 million per person or $4 million per married couple. But when we're talking about inheritance, right, when you're inheriting an asset, the estate has already paid taxes on that, right? So if Aunt Becky had to pay estate taxes and you get, her Tesla stock, that's already been paid for. Now you're not going to pay capital gains tax or income tax on that stock unless you hold it and it happens to grow from, the date you inherited it to when you eventually sell it.